Central banks and high net worth individuals are buying a lot of gold. And I mean a lot of gold. Gold is just at all-time highs last week at over $2,200 an ounce. And yet people and banks are still continuing to buy. Since late 2023, gold prices have been soaring. This is mostly due to constant buying of gold by large central banks, including China with 225 tons. Many believe the biggest reason China is buying all this gold is because they want to diversify their overall foreign exchange mix, which is part of their de-dollarization strategy. De-dollarization is a strategy that aims to reduce the US dollar's dominance in global markets by replacing it with other currencies. But what does this mean for the future of the US dollar and the global financial landscape? Will other countries follow China on its endeavor to buy more gold? Well, it seems they've already have. Does this mean you should buy? And what does this mean for the US dollar? Let's see. I want to let you know that this video is not legal financial advice. Be sure to do your own research, as buying gold and other speculative investments is risky. Thank you. All right, here's a scenario. Here is Tom. Tom has $1 million. He has $400,000 in stocks and $600,000 in cash. He wants to preserve his wealth, especially with high inflation in the past few years. Should he invest in gold? Let's see. Gold is often hailed as a hedge against inflation, increasing in value as the purchasing power of the dollar declines. Now, this is also good for Tom because gold's price movements may not always correlate with those of stocks or bonds, providing a buffer against market volatility. Next, gold is also a strong investment for Tom because it diversifies his exposure to the US dollar. In recent years, the confidence in the US dollar has shrunk due to many reasons. The risk of inflation. The US is in a high rate of inflation. The US debt levels. The US carries a lot of debt. Geopolitical uncertainty. In case of conflict involving the US, investors may seek refuge in alternative assets, including gold or other currencies. So effectively, by buying gold, he is less reliant on the health of the US dollar. Now, this might seem like the best investment ever, right? Well, not so fast. Let's say the market has gold fairly priced at $2,200 an ounce. Tom goes to his local gold dealer to buy some gold. When he goes inside, he's expecting to pay $2,200 for 1 ounce of gold. But when he picks up an ounce to buy, they charge him $24.20. How is this possible? Markups from reputable dealers vary with demand, but typically amount to as much as 10% of the value of the metal. Meaning, buying gold is similar to buying a car from a dealership. As soon as you buy gold, you've lost 10% right out of the gate. While Tom was trying to protect himself from 3, 4, 5% inflation, he was losing 10% the day he bought it from the store. The reason's the spread between the buy and sell price. Tom was upset, and for good reason. There has to be a better way to buy, he thought. And luckily for you too, there is. There's a far better way to buy gold, which is through mutual funds and ETFs. There's a lot of people that say, if you don't hold it, you don't own it. There might be some sense to that, because in case of an economic disaster, you might not be able to get your value completely out of it. But for Tom, buying gold was never something that he could barter or trade for goods. It was always about diversifying his portfolio, and really, that's all there was to it. So the golden question is, should you buy gold? And my answer is, it's complicated. If you're buying gold as an investment, I believe there's better options out there for you, like dividend ETFs or index funds. I personally have 10% of my investment portfolio as gold. I hold the GLD ETF, which is the largest physically backed gold ETF in the world. With over $57 billion worth of AUM, GLD tracks the price of gold by holding gold bullion in a trust kept in the form of London gold delivery bars of 400 ounces. GLD is also the most liquid gold ETF. I believe that if you were going to buy gold, buying it this way is the best way possible. This is because of the 10% markup that sellers charge and how hard it is to liquefy your physical gold. Historically, the price of gold doesn't outperform, but holds steady to inflation. So I personally do not look at this as a growth investment, but more as a safe hedge.